Most people don't lose money in crypto because the market is a scam. They lose money because they make the same mistakes again and again, and no one warned them early enough. If you've ever bought a coin and watched it drop 30% the next day, if you've ever sold too early and then saw price explode, or if you've ever thought, I'll just recover it with the next trade, this video is for you. Before we start, quick favor. If you want to avoid expensive crypto mistakes and actually trade with logic instead of emotions, subscribe now. It costs nothing, and it might save you a lot of money. Now, very important, this content is for informational purposes only and does not constitute financial or legal advice. Alright, let's get serious. The first mistake is the one that destroys accounts silently. People enter crypto without a plan. They open an exchange, see green candles, feel excitement, and click buy like it's a video game. No strategy, no rules, no idea where to exit. Trading without a plan is like driving fast with your eyes closed and hoping for the best. Sometimes you survive. Long term, you crash. A real plan answers 3 things before you enter a trade. Where do I enter? Where do I exit if I'm wrong? Where do I take profit if I'm right? If you don't know all 3, you're not trading. You're gambling with better graphics. Second mistake, overtrading. New traders think more trades equal more money. Reality? More trades usually equal more fees, more stress, and more bad decisions. The market doesn't pay you for activity. It pays you for patience. Professional traders wait a lot, sometimes days, sometimes weeks. Because one good trade beats 10 emotional ones. If you feel the urge to trade just because you're bored, congratulations. That's your sign to do nothing. Third mistake, ignoring risk management. This one is brutal. People focus on how much they can win, but professionals focus on how much they can lose. If one single trade can wipe out your account, your strategy is already broken. A simple rule that saves accounts. Never risk more than a small percentage of your capital on one trade. Not half your wallet, not this one feels special, just controlled risk. Survival comes before profits. Always. Fourth mistake, moving the stop loss. This one hurts because it feels logical in the moment. Price goes against you. You think it'll come back, so you move the stop lower, then lower again. That's not patience. That's denial. A stop loss is not a suggestion. It's a rule you set when you are calm, to protect you when you're emotional. If you keep moving it, you're telling the market, I'm not wrong yet, please wait. The market does not wait. Quick check-in. If this is already hitting close to home, drop a comment and let me know. You're not alone. Almost everyone learns this the hard way. Now let's talk about mistake number 5. And this one is sneaky. Trading based on emotions instead of data. Fear, greed, hope. These 3 destroy more accounts than bad analysis ever could. Buying because everyone is talking about it. Selling because what if it goes to 0? Holding because I don't want to accept the loss. Charts don't care how you feel. The market doesn't reward hope. The moment you feel your heart rate rise while trading, that's a signal, not to click faster, but to step back. Professional trading feels boring. If it feels exciting, something is wrong. 6th mistake, not understanding market context. People trade a 5-minute chart without knowing what's happening on the daily or weekly. They buy resistance, they sell support, then they blame manipulation. Higher time frames control lower ones. Always. If you don't know the bigger picture, you're trading blind inside noise. 7th mistake, copying trades without understanding them. Signals, influences, screenshots of profits. Tempting, right? But copying a trade without understanding the entry logic, the risk, the invalidation, is like copying answers in an exam without knowing the questions. You might pass once. Long term, you fail hard. Use others as education, not as crutches. 8th mistake, revenge trading. This one is dangerous. You lose a trade. Ego gets hurt. You want the money back now, so you increase size. You rush entries. You ignore rules. And suddenly, one loss becomes 5. The market senses revenge traders like sharks sense blood. Losses are part of the game. Your job is not to avoid them, it's to survive them. Pause. Reset. Trade again only when logic is back. At this point, you might notice something important. Most crypto mistakes have nothing to do with indicators. They're psychological, and that's exactly why most people repeat them. We're not done yet. In the next part, we'll cover the hidden mistake that drains accounts slowly, why most traders enter at the worst possible moment, and how to build rules that protect you from yourself. If you want. Part B, tell me and I'll continue. Before you go, do one simple thing. Subscribe and comment. This is how you stop losing money before the market teaches you the hard way. If you've made it this far, you're already ahead of most traders, because most people quit right before the most important mistakes show up. Let's continue. One of the most expensive errors in crypto trading is entering late. People don't buy when price is boring. They buy when price is exciting, after a big green candle, after Twitter explodes, after YouTube thumbnails start screaming. By the time everyone agrees an asset is obvious, the move is usually almost over. Markets reward anticipation, not reaction. If you're entering because it feels safe, it's often the most dangerous moment. Smart money enters quietly. Retail enters loudly. Another mistake that drains accounts slowly is ignoring fees and funding rates. It sounds boring, so people skip it, and that's exactly why it hurts. High-frequency trading with small profits looks good on paper, until fees eat half your gains. On leverage, funding fees can quietly bleed your position even if price goes nowhere. Always ask yourself, is this trade still profitable after fees? If not, you're working for the exchange. Now let's talk about something almost no one wants to admit, not journaling trades. Most traders rely on memory. Memory lies. Without a trading journal, you never really know why you lost, why you won, what patterns repeat in your behavior. A journal turns pain into data. You don't need anything fancy. Just write, entry reason, exit reason, emotion level. Over time, your mistakes become obvious and fixable. Another massive error, changing strategy too often. One week it's scalping, next week it's swing trading, then it's indicators, then it's price action, then it's this new strategy someone posted. No strategy works if you abandon it before it has time to prove itself. Consistency beats novelty. Most traders don't fail because their strategy is bad. They fail because they never stick to one long enough to master it. Quick reality check here, and be honest with yourself. If you're constantly searching for the perfect setup, you might actually be avoiding responsibility. Because if the strategy fails, it's not you, right? Growth starts when you stop running from your own data. Now here's a subtle but deadly mistake. Trading with money you can't afford to lose. The moment rent money is on the line, logic disappears. You hesitate to cut losses. You hold losers too long. You panic on normal pullbacks. Stress is not a badge of honor in trading. It's a liability. The market already applies pressure. Don't add more. Trade with capital that allows you to think clearly, not emotionally. Another common trap is confusing confidence with competence. A few wins in a row can make you feel invincible. You increase position size, you loosen rules, you think you've figured it out. The market loves to humble overconfidence. Winning streaks don't mean you're special. They mean conditions were favorable. Your job is to stay disciplined, especially when things are going well. Now let's talk about timing. Because this one hurts. Trading during low liquidity periods, late nights, weekends, low volume sessions. Price moves look clean until spreads widen and slippage hits. What looked like a perfect setup suddenly fills badly or stops you out unfairly. Liquidity matters more than most people think. The cleaner the market, the cleaner your execution. Here's another mistake that doesn't feel like a mistake at all. Holding losers longer than winners. People take profits quickly because they're afraid to lose them, but they let losses run because they're afraid to admit they're wrong. That single habit flips a profitable system into a losing one. Losses should be boring and small. Wins should be allowed to breathe. If your average loss is bigger than your average win, no indicator can save you. If this is clicking for you, take 2 seconds and comment below. It helps the channel, and it tells me you want deeper content like this. Now, one last mistake, and this one ties everything together. Not treating trading like a business. No rules, no review, no structure. Just vibes and hope. Real traders. Have routines. Review performance. Take breaks. Accept losses as expenses. If you don't act like a professional, the market won't pay you like one. Crypto is ruthless, but fair. It rewards discipline, it punishes shortcuts. And here's the truth most people don't want to hear. The market doesn't take your money, you give it away. One mistake at a time. The good news? Every mistake we covered today is fixable, not overnight, not easily, but systematically. If you want to keep learning how to trade with logic instead of emotion, subscribe to the channel and turn on notifications. And if you want the next video to go deeper into one specific mistake, write it in the comments. This is how you stop repeating errors and start trading with intention.